Hello and welcome to Rajya Sabha Television. You're watching a brand new edition of Policy Watch with me, Frank Pereira. India's industrial production registered robust growth for the second straight month, growing at 7.1% in December, while retail inflation slowed to 5.05% in January, signaling that the Indian economy may be stabilizing. The pickup in factory output was driven by a 8.4% growth in the manufacturing sector. Electricity and mining, the two other categories, expanded 4.4% and 1.2% respectively. It is likely that the recovery in factory output will augur well for the fiscal third quarter gross domestic product data due to be released on the 28th of February. In another signal that economic sentiment may be improving, the quarterly business confidence index released separately on Monday by the Delhi-based economic think tank National Council of Applied Economic Research, NCAER, registered a growth of 9.1% in January after declining for two consecutive quarters. On this edition of Policy Watch, we will analyze what the data released by the CSO means for the economy. Joining me on the program today are A.K. Bhattacharya, Editorial Director of the Business Standard, and N.R. Bhanumurthy, Professor, NIPFP. Thank you to both my guests for joining me on this edition of Policy Watch. I'd like to start with you, Professor. What do you make of the latest CSO data?
Well, I think there are positive, signals that's coming from both IIP numbers as well as CPI data. In fact, that strengthened my own argument that for the whole year 2017-18, we should be having a GDP growth little over what CSO has been projecting. So, in that sense, I think this is it's a good news for us. And as you rightly pointed out, the business confidence index also trying to show up very positive trends. So, the overall, the fourth quarter of the current financial, that is January to March, I think we will see a much better growth than what CSO has been predicted. But on the CPI numbers, I don't really read too much from small decline compared to the last month. The reason is, I think going forward, as RBI has very clearly projected, we are going to see some kind of inflationary pressures, not only because of the seasonal issues, but also due to some of the budget proposals itself, which already started kicking in terms of increasing the prices. So, overall, I would say that, the inflation would not be less than 5%, maybe it's close to 5.5% as the RBI projected.
Sure.
In that sense, the blip in CPI numbers, I guess it's more of a temporary compared to the trend.
So, it's going to increase in the near future is what you're suggesting. Okay. Considering that the inflation is well above the RBI target, Mr. Bhattacharya, can we expect some kind of measures from the Apex Bank and the government to try and control inflation, or do you think that it's okay if it's at the 5.5% mark?
Well, let me say that this is not yet outside the band which the RBI's Monetary Policy Committee and the government's Inflation Act mandates. What it says is that the inflation rate based on the consumer price index should move within a range of 2% to 6%.
Yes. So
4% being the central band. Now, it is true that after a long time, remember in January 2017, the CPI was barely 3.17% or so, and 1 year later, in January 2018, it is hovering over 5%. So, it is closer to 6 than it was a year ago. So, RBI is naturally little worried that it doesn't want it to breach the target of 6%. So, therefore, which is why the RBI has been cautious, and my sense is that they will wait till April when the new set of numbers will be available to them. What they fear is that if the government starts spending its resources as it is projected in the budget, because remember that the fiscal deficit has widened a bit, so more money will flow into the system, and the food inflation is from 0.17% in January 2017 is now over 4%.
Sure.
Now the increase even though it has come down from December to January, you see the elevated level of food inflation is at an uncomfortably high level of 4+. So therefore, it can be also politically be a sensitive issue, can be controversial. Therefore, the RBI will have to maintain a very close assessment and keep all its options open.
You know, Professor, Mr. Bhattacharya brought up the budget. You know, what kind of inflationary pressures are we going to see from the MSP for Kharif crops?
Well, I think there's still not much clear in terms of what is this MSP, the cost plus 50 that's going to be. And in any case, it's not going to happen within 1 year's time. See, it's only a signaling factor for the farmers in terms of the decision to go for production, how much production they would like to go. But overall, my guess is that the cost itself is going to be a controversial estimation. So the cost plus 50 will depend on the cost. So we have to wait and see how we are going to arrive at the cost. And my guess is that I think there's a lot of discussions going to happen next week, where the Prime Minister is meeting agriculture economists next week. And in any case, that is going to start reflecting on the prices only from the next financial year, or it may take more than 2 to 3 quarters from now on. So I don't see immediate impact of that particular decision on the agriculture prices.
As of now, is
what I meant was the prices may move north, not because of the MSP itself, but because of government spending more money in the last quarter.
It's on the demand side.
Yeah. So if there is any inflationary pressure, it will be felt not because of MSP prices, because as the professor rightly pointed out, they will not take in effect immediately. It will take some time before the formula is framed. So the challenge would be how to manage prices once the government opens its purse strings, so to say.
Sure. You know, from a 17-month high in December, inflation is now at 5.07%, still above the 5% mark.
That's
Mr.
right.
Bhattacharya, you know, what is really contributing to this high level of inflation?
Mainly food, in my view. I mean, remember that 54% of the consumer price index is consisting of food and beverages. Now, and if you see the food index within that, that is still remaining at an elevated level. So my sense is that it is the food and the vegetables and the beverages sector which has seen the increase, which has contributed to this inflation level remaining at that level. So therefore, and this has happened at a time when you are in the peak winter seasons. So with the onset of summer, the food inflation may get worse. So therefore, there is need for caution, management of the supply side, and also the farmers, contribution. In a sense, the farmers need to be taken care of.
Sure. You know, as far as some of the major indicators in the CPI are concerned, Professor Bhanumurthy, they have shown positive growth. What does it mean for the economy on the whole?
Well, is that CPI or IIP you're saying?
No, IIP, I beg your pardon, yeah.
See, well, I think there is a recovery. I mean, you have seen after the two major shocks that we have, Indian economy has seen, particularly Indian industry has faced, we are seeing some kind of a turnaround in most of the sectors. And I think that's what is reflecting in the IIP figure. So, which is one way it is like a postponed kind of production activity. On the other hand, we also see a lot of measures that has been taken care by the government in terms of easing doing business, or to some extent there is also some demand from the external sector. We have seen exports started showing up little bit. So all these things I think it's showing up in the overall IIP numbers. I think in my view it's a very positive trend, but I only hope that it will continue for some time, so that we'll see overall economic activity picking up.
Sure, yes.
An important thing in this entire IIP numbers is the uptick that you have seen in the capital goods sector,
Yes.
which is and plus the manufacturing sector. Both the manufacturing sector and the capital goods sector has seen an uptick, which is long-term positive news, because if you see capital goods sector an uptick, therefore probably you could conclude that are we seeing a kind of a turnaround in the investment climate where the capacity utilization is still very low. So therefore, if the capital goods sector growth is happening and manufacturing sector is also coming up with a better contribution to the IIP, so you may well see that whether the industrial recovery is probably in the making.
In a sense, the recovery is supposed to be, I think, seems to be structural. It is not just a temporary kind of thing.
It's not temporary. It seems structured is what you're suggesting. You know, what are the sectors that we need to watch out for going forward then, Mr. Bhattacharya?
We need to look at the manufacturing sector, because we need to see that the manufacturing sector is free from its infrastructure weaknesses. We also need to make sure that as the economy gets into an interest rate regime, which may not remain as soft as the sector would like, in a sense there is a greater chance of interest rates hardening because of the inflation rate not coming well below 6%. So therefore, we need to make sure the manufacturing sector, which is the key to your long-term sustained economic revival, actually gets its infrastructure in place, its availability of money in place, and plus I think access to credit for them and has to be better.
Sure. Professor Bhanumurthy, a quick closing reaction from you, concluding remark on, you know, what are the concern areas other than what Mr. Bhattacharya has mentioned?
I think one last word Mr. Bhattacharya pointed out is access to credit. I think that's going to be the major story for revival of the manufacturing sector for some more time. And you have seen the headlines today. I mean, there are a lot of issues in the banking sector. And I think we need to really set this banking sector issues. You have to solve that as soon as possible. Otherwise, whatever recovery that we are seeing now, it may not be continuing for long because of the issues relating to financial sector.
You know, several steps have been taken, Mr. Bhattacharya. Are they not working? What's the problem really?
No, I think some steps have been taken. Out of the 4 R's, you have seen recognition, you have seen resolution, you have also seen recapitalization, but I don't think we have seen enough of reforms. What we saw from the RBI side is further tightening of the NPA recognition norms, which is very good, but what we have yet to see is a proper reform in the way the banking sector, particularly the public sector banks, are operating, and that is not yet been looked at closely, and governance definitely. Otherwise, who knows, there are more skeletons in the cupboard, they may tumble out like the way it did in the case of the Punjab National Bank's Nirav Modi case.
Sure. All right. On that note, then we'll have to wrap up this segment of Policy Watch. Thank you to NR Bhanumurthy and AK Bhattacharya for joining me on the program and putting things into perspective for us. It's time for a short break now. On the other side, we will analyze the changes proposed in PPF rules and small savings scheme. Stay tuned. We'll be right back.
But when Prime Minister Narendra Modi comes here, how does it make how happy you are, or it is just a routine affair?
No, it's not a routine. It's very special and it's very important, and we value this very much.
So do you think that you are on the way of peaceful movement?
We are in the peaceful movement. We don't hide. At the peak of the revolution, it was armed struggle.
What is the least benchmark that you can give to Israelis to come on a common issue?
We are ready for good neighborly relationship, including in the economic field. In return, we simply want our right to self-determination and national independence.
Watch special interview of prominent Palestinian leader Dr. Nasser Al-Kidwa tonight at 10:30 p.m. only on Rajya Sabha TV.
Welcome back. You're watching Policy Watch with me, Frank Pereira. Well, the government on Tuesday proposed to make it easier for small savings scheme holders to close their accounts early, as well as permit the opening of such accounts in the name of a minor. At present, small savings accounts like Public Provident Fund cannot be closed prematurely before the completion of 5 years. The move, the government said, is to help deal with medical emergencies and higher education needs, among others. Further, the government also proposed amendments in the Small Savings Act to subsume the provisions of PPF accounts as well as small savings schemes under a single act. The legislative changes proposed in the Finance Bill of 2018 are aimed at adding flexibility in operation of the account under small savings schemes. The Finance Ministry said that all existing protections have been retained while consolidating PPF Act under the proposed Government Savings Promotion Act. In our next segment, we will analyze the proposed changes in the PPF rules. Still with me on the program now is A.K. Bhattacharya, Editorial Director of the Business Standard. And joining us right now is Ravinder Gupta, Joint General Secretary, All India Bank of India Officers Confederation. Thank you to both my guests for being here on Policy Watch. I'd like to start with Ravinder Gupta, of course. What do you make, of the changes in the PPF rules? The proposed changes, rather.
Basically, there is a time period earlier for your medical needs for you and the family members, as well as for the education, higher education for self and for family members. There was a clause that this was possible through some amendment 2016 that this could be possible, but the account must run for 5 years. After 5 years, this provision was there, but now this thing as the period has been reduced from 5 years to any number of years. So this is the basic amendment which is going to be happening in this.
PPF offers a lot of income tax benefits, and people, use it a lot as a result of that, or like it a lot as a result of that. Is that going to continue under the new proposed act?
Exactly. This is going to be continued. Basically, PPF is a scheme which has the exempt. 3 benefits are there.
Yes.
The first on the contribution, subscription, this is covered under 80C. Then interest is also covered under section 10. Interest income is also tax free, and at the time of maturity, the entire amount you are going to get, it is also tax free. So this is one of the popular and the most active, and the people have full confidence in PPF scheme for all these purposes. And apart from that, that yield and the return on the PPF scheme is much better than any of the scheme. Reason being, there is a tax saving also attached to this.
Sure. Mr. Bhattacharya, why has the government decided to change the rules now in 2018?
Well, there are many aspects to it. Number one objective is obviously which is streamlining. There are many saving schemes, and they are operated under different laws. Now, the government in its wisdom, and I think in this is the right approach, is to streamline all these different laws into one omnibus law that oversees and governs the various saving schemes which are in operation. So the attempt is to allow the various schemes continue to operate in their spaces, different spaces, but they come under the rubric of one omnibus law, so that their administration, their enforcement, monitoring are possible under a more streamlined and simpler way. That's number one. And number two is to remove the lock-in that was there in such investments. Now, when you remove the lock-in, what you are actually doing is that you're giving a kind of flexibility to the saver to come back into the scheme as and when he or she wants, or pull out the money as and when he or she wants. Now, right now what happens is that once you get into the scheme, then you are locked in for 5 years. You cannot take that money out before 5 years or close the scheme before 5 years. Now, that often acted as a disincentive for a large number of savers and investors not to come to the scheme, in the fear that I don't want to lock my money for 5 years, whereas I can make the same amount of money through equity. Now, what has happened is, with the long-term capital gains tax now being taxed, now what the government has done is that I'm removing the lock-in for 5 years. So those who think that they want to have a steady rate of return, and the steady rate of return is quite healthy here, may not be as healthy as in the stock market when they are doing well, but it is a steady, almost secured, capital protected return. And if you say you don't want to pay any taxes, so it's a good return. So therefore the savers have been given another benefit by removing the lock-in. Now remember, this has been done through the budget, the finance bill. A subsidiary law is going to be amended with an omnibus law will be in place. And the third element is that by doing this, the government is actually ensuring that it has access to another source of money to meet its borrowing requirements. Remember, the small savings schemes help the central government to meet a small portion of its total fiscal deficit requirements. Now, it need not necessarily depend on the market borrowing program, which are right now going through some rough times because of the bond yield spiking. So therefore, probably by making the small savings schemes little more easy and more attractive for people, it is hoping to meet the gaps that it might see in the coming months through this national savings schemes and the small savings schemes, so that its cost of borrowing is also little more manageable rather than going in for borrowing at a higher rate of interest.
A three-tier benefit is what you're suggesting, as far as this particular scheme is concerned. You know, Ravinder Gupta, who stands to benefit the most from the proposed rules?
So basically, in the proposed rules amendment, this is only one amendment which is coming. This is only the reduction the number of years. So persons, those are really need in the medical treatment and for the higher education. Apart from that, we are talking about the PPF. PPF is a scheme for the retiral benefits to accumulate money for the savings for your old age and other this thing. This is a medium term and the long term sort of scheme. The number of maturity will remain the same, 15 years, and beyond that you can extend for 5 years and all that. But proposed legislation which is coming, that is only the reduction to the 5 years. That is going to benefit. But rest of the things will remain same. That income tax rules, those are applicable here, as well as the attachment orders. There was an apprehension that by repealing this PPF, all the benefits needed to the PPF will maybe wiped out. But after conversion into the Government Savings Bank Act 1873, all the benefits attached to the PPF scheme will remain same. Court degree or attachment by the court, that benefit will remain with the same. Income tax, they can attach the PPF account. So PPF only provision which is going to they are going to make, that is only the reduction in the number of years as per this bill.
Sure.
Or the minor, the opening of the small savings scheme for in the name of the minors, but that provision is already there in the PPF scheme. PPF scheme, a parent can open an account in the name of one minor.
Sure.
That is already there.
Sure. You know, Mr. Bhattacharya, what would the government like to achieve from these new proposals on the whole?
Well, one, I think it will be able to attract more savers because what Mr. Gupta was saying, let me explain it more, that right now you cannot close an account before 5 years. But under this, after this amendment, you can close the account before 5 years.
But the clauses remain the same under medical emergencies and under higher education.
Exactly.
And
now what was to happen was, if your other saving schemes, let's say you save under the EPFO scheme, now there also you are allowed to withdraw money on account of medical emergencies or on education.
Yes.
So government is also trying to bring in uniformity in various EE schemes where, as Mr. Gupta was explaining, that exempt category EPF is also an exempt category schemes, wherein you have the facility of withdrawing that money, not getting taxed as long as you are using it for medical or health reasons, education reasons.
Yes.
So I think they're trying to bring uniformity and also trying to attract more people to come under these schemes at a time when the savers need more revenues for parking their money to get safe and secure returns.
You know, PPF is one of the most popular savings schemes. So with these new amendments, do you believe that there are going to be more takers for the PPF scheme?
My sense is that when it comes under one streamlined, one omnibus law, and the government can also focus its energies on managing these schemes under the rubric of one law, my sense is that it will be easier to operate, and therefore you can expect more people to come and get drawn towards them.
Okay, I've got about 1 minute left on the program, so I'm going to try and get quick closing comments from both Ravinder Gupta and A.K. Bhattacharya. Ravinder Gupta, do you see any issues cropping up when you talk about one omnibus act like Mr. Bhattacharya has been saying?
No, it is going to be very easy. Reason being the new act, I mean this is an old act, that is Government Savings Bank Act 1873, other acts will be repealed with the introduction of this thing. That act says about the savings bank accounts of the country, in the entire country, and that disposal of the accounts and the disposal of the deposits of the people and all that. And it is going to be very easy because so many other acts will not be there, so that it will definitely ease up the settlement of the funds for the depositors.
Sure. Mr. Bhattacharya,
I would say that I think along with this streamlining through an omnibus law, there is a bit of need for a bit of more promotion of these schemes, because right now these are one of the oldest schemes of the government for encouraging savings, but they are hardly promoted and talked about. So probably after this streamlining and the flexibility being introduced, the government probably needs to do some promotion of these schemes so that there are more savers, more investors who are willing to experiment with these new facilities.
Sure, yes, Mr. Gupta.
And the biggest part of this is the entire deposit, this is a government liability towards the depositors. All the amount comes in this PPF scheme and the small scheme, this belongs to the Government of India, rather it's a liability towards the depositor.
Sure. So it's extremely secure is what you're suggesting.
This is a sovereign guarantee is there. This is a 100% secured deposit of the depositors.
Indeed. All right. On that note, then we'll call it a wrap on this edition of Policy Watch. I'd like to thank A.K. Bhattacharya and Ravinder Gupta for joining me on the program and putting things into perspective for us. Before I go, of course, you can send your suggestions and your feedback to our email ID policywatch.feedback@gmail.com. That's it from me. See you again next time.